Well, it looks like you guys have berated me with enough comments to finally get me to talk about ETFs. Now, I don't personally like to invest in ETFs myself because I feel like it takes a little bit of the fun out of investing, and I just like to spend hours and hours of researching individual companies and trying desperately to beat the market over the long term. However, I also think that if you're either number one, new to investing, or number two, you just don't have enough time in the day to be spending hours and hours researching individual companies on a very deep level, then I think ETFs might be perfect for you because it's like owning a diverse group of stocks in a single stock. So today I'm gonna pretend like I'm forced to invest in 3 brand new ETFs. And so I'm gonna choose, the first one will be a low risk, kind of low reward ETF. Second one will be more of a medium risk, but potentially a little bit higher reward as well. And then the third one, I'll choose a high risk, but potentially high reward for the long term. So I think it's gonna be a lot of fun. Make sure you hit the like button if you wanna see more videos on ETFs and just in general, because it really helps the channel survive and grow as well. So with all that said, let's go ahead and get started. What's up, everybody? My name is Ale and welcome to my world of stocks. Now, as you guys know, I used to focus almost exclusively on growth stocks that had a lot of capital appreciation potential for the long term. But as I've matured with age, I've started to diversify a little bit, and I've been trying to invest a little bit more into good, solid companies that pay sustainable and reliable dividends over the long term. So for ETF number 1, I decided to go with a well-balanced dividend ETF. And this one is called Spider S&P Dividend ETF, ticker symbol SDY. And there's really a few reasons why I really like this one. For starters, the ETF invests at least 80% of its assets in tracking the S&P High Yield Dividend Aristocrats Index. This is really appealing to a dividend investor like myself because it means that every single stock in this ETF has not only paid dividends for the past 20 years, but has actually increased those dividends every single year in a row, even through a recession or difficult macroeconomic conditions, making this ETF a little less risky for me, and I can essentially expect to receive dividends every single year. However, there's a couple asterisks to this. For one, you might be thinking to yourself, wait a minute, I thought dividend aristocrats increased their dividends for 25 straight years, not just 20. And that is true, but this particular ETF focuses on 20 years instead to give it a little more flexibility in the stocks that it chooses. There's actually another ETF with the ticker symbol NOBL that I believe only chooses stocks with a 25-year growth history, and I'd be completely fine choosing either ETF, but I went with SDY because it currently has a higher yield of over 3% trailing, while NOBL is much closer to 2% according to Seeking Alpha. But back to SDY, you might notice here that they only have 1 year of growth, and that's actually pretty common among dividend ETFs because of the stock turnover. Sometimes ETFs need to swap stocks in and out to meet specific criteria, so the dividends will fluctuate a little year to year. But overall, if it's a good dividend ETF, which in my opinion this one is, then you should generally see growing dividends over the long term. Of course, capital appreciation is another benefit to well-performing ETFs, and SDY has climbed by almost 3 times their share price in the past decade, and more recently, the ETF is up over 36% in the past 5 years and up over 10% year to date. Of course, this also means that it's trading at some of its highest levels in history, so I would consider waiting for a significant pullback before jumping in. But in the long term, it remains a pretty solid ETF in my opinion. And finally, I'll just quickly mention their top 10 holdings that are AT&T, which I actually own myself, IBM, ExxonMobil, People's United Financial, Leggett & Platt, Realty Income Corporation, Chevron, Cardinal Health, National Retail Properties, and AbbVie. I personally like Exxon, Chevron, Cardinal, and AbbVie, although I'm not currently invested in any of those. Oh, and by the way, they currently have 112 holdings, over $18 billion in assets under management, and an expense ratio of 35 basis points. And if you want to know more about their exposure, you can pause the video here, but they basically have 100% exposure to the US, and their biggest sector is financials, although they are pretty well diversified across several others. Okay guys, moving on to ETF number 2, I decided to go with a Chinese ETF, and this one is called CraneShares CSI China Internet ETF. I think I have that right. Ticker symbol is KWEB, so KWEB. And there's a few reasons why I chose this one, particularly because I am very bullish on Chinese stocks over the long term, and especially the stocks that we'll talk about in a second. But I'm not oblivious to the fact that a lot of these Chinese companies or stocks carry a lot of risks along with them. See, China doesn't allow foreign ownership of many Chinese companies in certain industries, so what some of those companies do in order to attain foreign investment is they use a modified corporate structure called a VIE, or variable interest entity. And that's essentially a shell company, usually located in the Cayman Islands, that acts as a sort of middleman, funneling your cash as an investor to the actual Chinese company that you want to invest in. And what that means is that you're essentially buying the shell company rather than the actual Chinese company, so you lose certain rights as an investor. Another concern is that if the Chinese government decides to make VIEs fully illegal, then it may be possible for investors to lose their invested money, although I personally don't think it would ever come to that, but it's still a risk nonetheless. And so my point is that some investors might feel more comfortable going with a diversified ETF rather than investing in individual Chinese companies that could potentially screw you over if they decide to do something shady. Well, in this case, my favorite Chinese ETF is KWEB because they mostly track an index that is heavily invested in internet and internet-related sectors in China. In fact, over 75% of their exposure is to the software and IT services sector, with over 75% being in China, 20% in more specifically Hong Kong, and 4% in the US. That's a big deal because China's overall economy may be slowing down, but their internet sector continues to take off. In fact, revenue of internet companies in the first half of 2018 grew by a massive 23%, while investments in research and development grew by 17%. Total revenue generated by the information services sector grew by over 23%. Revenue from e-commerce platforms grew by 39%, and revenue from online games grew by over 23%. All of these are markets that the ETF is heavily involved in, as you can see in their top 10 holdings, which are actually stocks that I'm very interested in myself. In fact, I recently started investing in Alibaba, and that happens to be their largest holding. But this also includes some other very popular Chinese companies like Tencent, Baidu, JD.com, and IQ. Tencent is arguably the biggest gaming-related company in China among numerous other things that they do, and JD.com is also very important to China's fast-growing e-commerce market, just like Alibaba. In fact, China's e-commerce market is projected to reach $1.8 trillion by 2022, and JD and Alibaba are the two biggest players in that market at 16 and 58% market share respectively by online sales according to Statista. And while the ETF is technically up over 21% in the last 5 years and year to date, it's actually down over 31% in the past year, mostly because of the slowing down Chinese economy and the trade fight with the US, both of which are issues that I think will be resolved in the long term, at which point I think the ETF could perform significantly better than it has in the past year. By the way, they currently have 52 holdings, over $2 billion in assets under management, and a fee of 70 basis points, which I do think is a little high, but might be worth it for the great exposure to China's tech industries. Also, they apparently pay a dividend, but according to Seeking Alpha, their trailing yield is only 0.02%, so it doesn't seem like it's very meaningful, but I'm more interested in capital appreciation with this ETF anyway, so it's not really a deal breaker. Okay, so for my safe pick, I went with a dividend ETF. And then for my medium risk, I went with a Chinese ETF. Now for my high risk, I'm actually going to go into the marijuana industry, and I'm going to go with an ETF that is called ETFMG, Alternative Harvest ETF, ticker symbol MJ. And the reason I chose a marijuana ETF is because the industry as a whole is set for enormous growth. According to Marijuana Business Daily, cannabis retail in the US alone will bring in over $22 billion by 2022. That's more than double the numbers we saw last year. And most of that enormous growth is from recreational use, which should keep climbing given that at least 33 states have already legalized medical marijuana, with 10 of them legalizing both medical and recreational. Not to mention that there are many markets worldwide that will experience similar growth in the future, with Canada alone being estimated to be worth somewhere between 4.9 and 8.7 billion Canadian dollars. And so I chose this ETF because it was the first pot-focused ETF trading in the US, and it holds around 30 stocks at a time and rebalances them quarterly to include companies that engage in cultivation, production, marketing, and distribution of cannabis products, including both medical and recreational. As a result, their two biggest sectors are healthcare and consumer non-cyclical, with their biggest country exposures being Canada, the US, and the UK, among a variety of other countries in smaller amounts. And as you guys have seen in my previous videos, some of my favorite marijuana stocks out there are Aurora Cannabis, Cronos, Hexo, and Canopy, and MJ includes all of these in their top 10 holdings that make up over 60% of their portfolio, with Aurora Cannabis being their number one holding, which is also my favorite weed stock. Now, they currently have 35 holdings with $1.15 billion in assets under management, and their fee is a little expensive at 0.75%, but I think it's worth it if you want exposure to the marijuana industry without having to invest heavily in some individual companies that are losing a ton of money and could potentially go out of business or greatly damage your portfolio with poor performance. Speaking of performance, the ETF is just as volatile as a few other weed stocks out there, so I would definitely wait for a significant dip before jumping into this ETF, given that it's already up almost 50% year to date and we're only less than 3 months into the year. So I would say that the price looks a bit high at their current levels of around $37. They do, however, pay a pretty nice dividend according to Seeking Alpha that is around 1.5% trailing, although it also looks like that dividend has been declining in the past few years. In any case, this of course is an ETF that holds many companies that, again, are not profitable and are actually losing money at a pretty alarming rate, yet they have very, very high valuations. So if you were to look at like the PE ratio of just this ETF on its own, if you were to actually look at all the PE ratios of every holding that it has, because I don't want to get it all into this, but a lot of websites and research sites, they calculate PEs of ETFs a little differently, and sometimes they won't include companies that are actually not profitable. But if you were to actually look at all the PEs of this entire ETF, you know, it's not going to be a very pretty picture. So there is still definitely a level of risk involved with this ETF. You know, a lot of people think, well, ETFs are just very safe. You know, that's obviously not true. As you've seen with some of the charts that I've already showed you, you know, ETFs can definitely take some big hits. And of course, the marijuana ETF is not going to be any exception to that. However, again, it does add a little bit of a wider exposure, and you're not limiting yourself to just one or two marijuana companies that could potentially go through some big struggles just kind of on an individual basis. So for that reason, I do still like this ETF. It also pays a dividend, and just kind of in the general sense for the long term, I really do think that the marijuana industry will be worth a lot more in the future than it is right now. So I wouldn't have a problem holding an ETF like this for the very long term. But again, I would like to get it at a much cheaper price. It does look like it's a little bit high at the moment. Okay, so I think that just about does it for this video. Let me know what you think. What do you think about these ETFs? Let me know if you like them or don't like them. I know a lot of people can be very passionate about these type of things, so just try to keep it clean. But let me know if there's any other ETFs that you like more, and I'd love to hear your thoughts and reasons why. Again, I'm not really an ETF investor myself, so I think there's definitely other ETFs out there that you might like a lot more. But these are just kind of 3 that I would choose if I was forced to invest in a couple ETFs. But anyway, again, let me know what you think. Hit the like button if you enjoyed the video, if you want to see more videos like this, and subscribe if you haven't already. And thank you for all the support. I'll see you guys in the next video. Take care. Bye-bye.